Nilesh Shah, Managing Director and Chief Executive Officer of Envision Cap joins us. Nilesh, morning. Thank you for joining us. Always a delight to have you back. Nilesh, if I look at the broader market environment, it is a situation of local versus global. Globally, things are in a good groove, but locally, things are looking subdued. So which, to your mind, will influence our markets in the near term? Local sticky situation or global momentum?
Well, yeah, I think on the global side, I think it's a mixed bag. While the Europe continues to basically face new challenges with every passing day, and China continues to basically witness some kind of landing, the US continues to basically do well, and the economy seems to be doing much better. I think in that context, right now in India, the news flow is not all that positive. Clearly, I think what basically the market really is looking forward to is several policy initiatives and a lot of clarifications on various policy matters. I think if any of these things do happen, then it's quite possible that the stickiness that we are witnessing in the market could basically go away.
Nilesh, do you worry about the course the Q4 earnings have taken, as most companies have reported a decline in the revenue growth and a drop in margins?
Absolutely. I think clearly the Q4 numbers do not bode well, particularly for the first half of FY13. And if you take that as an indicator, revenue growth has slowed down from about the 20% plus to about 15 to 17%, while net profit growth is no longer there. If at all, there's been a degrowth on the net profit growth. And that's possibly a situation which might persist for the first half of FY13 and maybe for the entire FY13.
Nilesh, why are banking stocks underperforming after a rate cut? Because the chorus on the street ahead of Fed policy was that if Reserve Bank of India does a rate cut, banking stocks in the near term will get re-rated, but they have not got re-rated, they've got derated.
That's because if we really look at banking and we split it into two pockets, one is basically the good pocket, which is basically the larger private sector banks, where clearly they do not have problems of asset quality. But the challenges which would come for them is basically growth in operating profits. We believe that to some extent the growth in operating profits, which is operating profits before provisions, has slowed down significantly, and we clearly think that the valuations, current valuations, do not factor that in. On the other hand, a lot of banks which have been following a balance sheet heavy model are having serious challenges of asset quality, and we clearly think that the worst is not yet over in terms of asset quality. We might still see one or two more quarters of pain from an asset quality perspective, and therefore that could lead to further deterioration in their stock price as well. So I think it's because of these reasons that the banking sector has underperformed in the recent times.
Nilesh, there's a reason why consumer companies are outperforming. High growth, they've got strong cash flow, global uncertainties as well they've been wading through. At these levels, are large cap consumer names reaching a bubble-like situation when it comes to the valuations?
Well, I clearly believe that most of the consumer companies essentially, and particularly those companies which are into the consumer staples business and are into non-discretionary consumer spending, I think are great companies. But I don't think that they're great investments at these levels. You could continue to see a lot of outperformance from them, given that the market is in a defensive mode and investors are willing to pay abnormal premiums for quality and visibility. But I don't think that's something which is going to sustain on a permanent basis. It could still carry on for a few more quarters, but definitely not for many, many years to come. So I think clearly the opportunity within the consumer space is to look out for a lot of companies which are into discretionary consumer spending, where growth has slowed down a bit and where valuations have come off, prices have come off between 20 to 40% from their highs of 2010, 2011. I think that's clearly the pocket to really look forward to.
All right, Nilesh, let's talk about Infosys, and I know you tracked this one with a magnifying glass. Do you think at these levels Infosys Technologies could be a good solid contra idea? The fact that currently BFSI vertical for Infosys is in problem, but given the way how US economic recovery has bounced back, do you think in the second half Infosys could surprise us on the upside?
Well, it's become basically the favorite whipping boy in the last few weeks. Clearly the guidance that they have given is below the industry guidance. They have clearly missed the guidance for the last quarter. So I think clearly from that perspective, to some extent, I think a lot of criticism which they have faced in recent times, I don't think is probably off the mark. But having said that, clearly from a stock perspective, the stock has been an underperformer to a lot of the other bellwethers in the sector. And clearly the price erosion that one has seen over the last maybe 3 to 6 months, I think has made valuations very, very attractive. And I think the company is going through some kind of a transition as it focuses more on products, platforms, solutions, consulting, and as it reduces its exposure on BFSI. I think once it basically does this transition, I clearly think that its stand would get vindicated and the current valuations make it an attractive investment from a medium-term perspective.
Nilesh, most autos have been outperformers up until now, but at these levels, autos are trading at reasonable valuations of 17 to 18 times based on the FY13 estimates. Is there merit in buying autos at the current levels?
It's very likely that the outperformance that they have given and the absolute returns which they have given over the last, in recent times, that's something which may not sustain. And I think the key variable to watch for auto stocks is basically, of course, one is interest rates, but more importantly, monsoons. I think if the monsoons would be all right, it's quite possible that volume growth would come back. But otherwise, I think the sector is likely to face single-digit volume growth, which can contribute to some bit of underperformance for the sector.
So Nilesh, at a time when you expect that Indian markets will remain range-bound for next 2 or 3 quarters and it's time to focus on individual companies or group of stocks, where are you picking up your spots?
I think there are 4 broad opportunities which one needs to basically be focused on, which is, as I said, is the discretionary consumer or discretionary consumption space. That's 1. 2 is agri-input plays. 3rd is basically undervalued private sector banks. And 4th is basically opportunities like auto components, which we believe are scalable over the next many years. I think these are the 4 very broad, interesting opportunities. In addition to that, I think one would be very watchful of the capex and the investment space and would look forward to a recovery in the investment cycle to basically find the winners in that space.
So what's your call on the index after it being so range-bound for the last fortnight or so?
I'd say that yes, I think I would probably continue to, of course, be cautious and be watchful and vigilant. But I think one would want to basically change one's stance and be a little more optimistic than what one has been over the last 1 or 2 years.
Nilesh, I understand from market insiders that the fund which you managed was one of the best performing fund for FY12. So my compliments on that. What was the performance?
Well, I wouldn't want to get into specific returns of the specific fund, but I could say that we did manage to achieve substantial outperformance to our benchmark.
So, Nilesh, how are you planning to differentiate for FY13? FY12 you managed to beat your peers. For FY13, how will you achieve that again?
Well, I think now onwards we look forward to just not protection of capital. Of course, that's always going to be there. But I think we'll continue to now scout and invest into opportunities which can basically offer reasonably good returns from a medium to long-term perspective.